Let's review the journal entries for a merchandising company using perpetual inventory. The Old Spokes home sells bicycles. One popular item they sell is the street peddler. Spokes uses a perpetual inventory to account for their inventory. Prepare journal entries to record the following merchandising transactions. So as we go through each of these, we're going to analyze each transaction and determine how we would record it in the general journal. Keep in mind, every time you record in the general journal, you must also post to the ledger. We're leaving out that step for this problem. March 7th, Spokes purchased 10 street peddlers on account at $1,050 each, terms 210 and 30 FOB shipping point. Now let's discuss some of these options. First off, the terms were 210 and 30. That indicates that it is on account, even though it does state on account there. But by having credit terms, we know that this was sold on account. And again, read those from left to right. It's a 2% if paid within 10 days. Otherwise, the net is due in 30. Now, FOB shipping point. There's two different types of shipping terms, FOB shipping point and FOB destination. FOB shipping point, FOB stands for free on board. In this case, the shipping point refers to two things: when title transfers, and it indicates who has to pay for freight. In this case, the title of the goods transfer upon shipment of the goods. So the buyer owns them at the moment they're shipped. That's the title of transfer of title then. And then under FOB shipping point, the buyer is responsible for paying the freight. So we know, since we are Spokes and we are the buyer, we will eventually have to pay for the freight for these individual items. So under perpetual inventory system, we're first going to take the 10 street peddlers times the 1,050 each. So that tells us we're buying 10,500 in inventory. And again, we reserve inventory for that word. Those are items that we purchase solely for resale. So since we're buying these to resell them, we'll place them in inventory. Now, since it is on account, we owe the money, so we call that an accounts payable for 10,500. On March 12th, it says that Spokes returned 2 street peddlers which were damaged. So in this case, we're sending them back to our supplier. Well, when we send them back, the first thing that's going to happen is we no longer owe for them. So we need to reduce our actual accounts payable by the amount. And again, it's 2 bikes at $1,050, so that means we no longer owe $2,100. Now, what's the offset to that? Well, keep in mind we returned bikes that we had for sale, so we need to show that we are reducing the number of items we have for resale. So our inventory will also go down by $2,100. Again, this is a perpetual inventory system. Then on March 12th, it also says that Spokes paid freight on the purchase for $450. Again, we knew we were responsible for freight because it said FOB shipping point, which means the buyer has to pay. So we are going to have to pay for that. Now, when we pay for freight, under perpetual inventory, it actually goes into the cost of the inventory. It's required for us to get the inventory, therefore it's part of the cost of inventory. Now, when we purchase something or buy something or pay for something, we can either do it on account or we can use cash. In this case, it says that we paid cash, so our cash is going to go down, so we need to credit that account. So a little bit about inventory. Remember, inventory is an asset to us. It brings us future benefit because we can sell it and receive cash eventually. So that is one positive. It should have a normal debit balance since it is an asset. It will show up on the balance sheet. Of course, it is a permanent account, which means we will not close it at the end of the period. All right, March 15th, Spokes sold 14 street peddlers on account for $1,540 each. Terms were 210 and 30 FOB shipping point. And again, same concept. Here, though, instead of being the buyer, we are now the seller of these goods. And notice it says we sold 14. Well, we only bought 8, so that tells me that we had some street peddlers on hand in the beginning inventory. So that's sort of a key there, that we did have some of these prior. So to record the sale, the first thing we have to do is decide, did we sell it for cash or on account? It tells us on account. So we're going to take that $1,540 per bike and multiply it by the 14 bikes that we sold. So we know that our customer owes us money, our customer or customers owes us money. So we're going to put that into accounts receivable, and that would be $21,560. Again, make sure you're doing these calculations with me so you understand them. That was 14 street peddlers we sold for $1,540 each. Now, remember revenue recognition. Anytime we perform a service or sell a good, as long as our obligation to our customer is complete, we get to recognize revenue. So we're going to credit our sales revenue, $21,560. Now, we have to take this one step further. Since we're dealing with a perpetual inventory system, the next step in the process is we actually need to record the cost of goods sold. Anytime in perpetual we sell goods, we recognize the cost of goods sold and the reduction in inventory. So to do that, we need to debit cost of goods sold. Keep in mind, cost of goods sold is an expense account to us. Even though it doesn't have the word expense, it is an expense to our company. We recognize it when we sell the good. Since it is an expense, it should have a normal debit balance. It would show up on the income statement. And since it is on the income statement, it would be reset at the end of the year. So we consider it a temporary account. So now we need to figure out the cost of goods sold. Well, remember, this is an average, or what they actually tell us. We don't have to figure it out. We don't know how much our beginning inventory costs us. So it just says use a cost of $10.50 each. So we're going to take $10.50 and we're going to multiply it by the 14 bikes we sold. So that tells me the cost of the goods we sold was $14,700. Now, once we record the cost of goods sold, we need to show the reduction in inventory. So we're going to reduce our inventory by $14,700 as well. So anytime we have a sale, we record the sale first. Then in perpetual inventory, we show the cost of goods sold and the reduction in inventory. Keep those as separate entries so that you will not confuse yourself. All right, March 17th, we paid the amount owed on credit purchase of March 7th. So again, here we're paying off an account. So when we pay off an account, we know we have to reduce the balance that we owe. So we need to reduce the accounts payable. Now we need to ask ourselves, how much did we owe? Well, we do have to be careful. Remember, we did on March the 7th purchase $10,500 worth of inventory. But we didn't keep all that. We actually returned 2 of those for $2,100. So you need to reduce that by $2,100. So at this moment in time, we owe on our account payable $8,400. Now, just because we owe that amount doesn't mean that's the amount we're going to pay. So then we have to ask ourselves, were there any discount terms? And if so, were we within the discount period? So this was March 7th. Terms were 210 and 30. So that means we get a 2% discount in 10 days. We are within the 10-day window because this is the 10th day. So we do get the discount. So that tells me that we're not going to pay all of that in cash. So I'm going to go down here and I'm going to figure out how much I owe in cash. Remember, we get a 2% discount. So if we take that $8,400 and multiply it by 2%, we get to reduce the amount we pay by $168. So if you take $8,400 minus $168, you get $8,232. That's the amount we actually need to pay for our goods. Well, that causes a little bit of an issue because remember, debits must equal credits, so now we need $168 for something. Well, in that case, since we're using perpetual inventory method here, it would actually reduce the price of our inventory. We didn't pay 100% for our inventory, we paid 98%, so to speak. We got a 2% discount. So our inventory needs to be reduced by $168 there. All right, the next one, on March 25th, we granted a sales allowance of $100 on the March 15th sale. Remember, a sales allowance is a discount that we give a customer. Maybe they want to return a good. So in order to get them to keep it, we will offer them a sort of an additional allowance so that they do not return the good to us. We try to make them happy even though it wasn't exactly what they wanted, and it saves us from having a return. When we have a sales allowance, we actually debit the sales allowance account for the amount of the allowance. So this was $100 off the price, so we're going to record that for $100. And then we actually need to reduce the amount our client owes us. So we're going to go in and we're going to credit the accounts receivable. When they take an allowance, it physically reduces the price, so they do not owe us those funds. All right, and then last but not least here, of course, March 31st, we collect the amount due from the March 15th sale. So we have our receivable here, now we're collecting on the receivable. Well, when we collect on a receivable, we're definitely going to receive cash. That's the only way our customer can physically pay us. Then we have to ask ourselves, well, how much? Well, there's two things going on here. First, when we initially sold to our customer, it was $21,560. But keep in mind, we have to take into account any returns or any allowances and any discounts. So as we look down through here, remember they did receive the $100 allowance. So we're going to subtract the $100. So right now on our books, we have that our customer owes us $21,460. So now let's look for any discounts. Remember, we did sell it 210N30. Well, are we within the 10 days? No. See, we're 16 days about out here. So we're outside the 10-day window. So that means our customer does not receive the discount. So they owe us $21,460. Then, since they're paying us, we need to reduce the accounts receivable by $21,460. I hope this sort of helps you review how to do journal entries for a merchandising company.